So let's say you get a question on group audits. The question is often to do with planning, or it could be to do with the problems that you'll face when taking on a group audit. So I'm going to help you a little bit here about the sort of things that you need to be thinking about. Okay, and there's quite a few, so be aware. First of all, you need to make sure that you understand the group structure, so you know which components should be consolidated. Are there any associates that need equity accounting, and that sort of thing. You need to be aware of materiality. Okay, remember, if you've had an acquisition during the year, then obviously your materiality is going to increase because the percentages will increase. And also think about the materiality of the component. Okay, because not all components, not all subsidiaries need to be audited. So be aware of that and the acquisitions this year. And of course, the same would happen with the disposal. Your materiality would go down. Goodwill then, things to think about here. Well, think about your goodwill calculation. So the things to think about are the fair value of consideration. If it's in the future, it needs to be discounted down to present value. If it's a contingent consideration, it needs to be shown at fair value. Make sure they've got the NCI right, calculated in the right policy, proportionate or fair value. And then also the fair value of net assets acquired. You need to think of things like how could you get the fair values? Can you check them? Have they been valued correctly? And also then check for impairment. The recoverable amount has the fair value less cost to sell, and the value in use been calculated correctly as well. Don't forget that all this is kind of P2, isn't it? But don't forget that you don't need to do numbers in this exam. It's all just words, okay? So just the words is all that's needed. Consolidation principles, like the holding company and the subsidiaries, you add across 100% and then the NCI comes out at the bottom. Or the associates, you don't add across, it just has one line. On the income statement, if you acquire a subsidiary during the year, make sure you're aware that you only include it since acquisition. Think of things like the subsidiary and the holding company have to have the same year end, have to have the same accounting policies. Okay, so bringing all these together. Additions during the year, the things to think about are step acquisitions. If it's a step acquisition, then when it goes from 10% to 80%, you need to revalue the original 10% to its fair value when you get the 80%. A further acquisition is when you go from, say, 80% to 90%. Well, here, then you're not creating any more goodwill or anything. You're just buying from the NCI. So here, NCI should go down, and the difference between how much it goes down and what you pay should be shown in reserves and not in the income statement. Disposal, similar sort of thing. You're going to have two. A partial disposal is when it goes from 90%, say, to 80%. You don't lose control. And again, you just sell into the NCI. And so the NCI will therefore increase. And the difference between the NCI increase and the proceeds that you receive, again, the difference goes to reserves, not the income statement. On a full disposal, though, say from 80% down to 30%, it's called full because you've got rid of the subsidiary. Okay, so everything to do with the subsidiary needs to come out, which means all the net assets, all the goodwill, all the NCI. Okay, you take all those out, you compare it to the proceeds that you received, you compare it to the 30% that's left over, and the difference goes to the income statement as a gain or loss on sale. Remember also the 30% that's left over, that needs valuing at its fair value, and then that would just carry on as an associate or as an investment. Intergroup transactions, remember in a group, they would need cancelling out. So intercompany balances or transactions like unrealised profit need cancelling out. Analytical procedures could become really useful to us if we've got lots of subsidiaries, because if they're similar subsidiaries, then the analytical procedures may just be enough if the subsidiary is small enough, because we know that if we always make a 20% margin, the sub should as well, that sort of thing. Other auditors, component auditors, we've already studied those in the previous section. Accounting policies, as we said earlier, they need to be the same, so you might have to make some adjustments. You probably will have to make some adjustments when doing the group accounts. Make sure the timetable is right, that the component auditors know what the timetable is and when they have to get things to you, etc. Foreign subsidiaries, lots to think about here. You translate the balance sheet of a foreign subsidiary at the closing rate. You translate the income statement of a foreign subsidiary at the average rate, and the difference goes to reserves. The other thing that you need to think about as well is goodwill. That needs retranslating every year, and again the difference goes to reserve. Actually goes to a translation reserve. And finally, make sure you deal with associates correctly. Don't add them across. Just one line in the balance sheet and one line in the income statement. It's called equity accounting. So you can see, you've got a lot of stuff to remember there. You really have. So if you do get a question about group audits in general, try and think of this. Try and think of disposing of magic pasta. Okay, disposing of magic pasta, and that will at least give you a chance to try and remember some of these things. Remember, in this exam, it's all about making lots of points, making depth in your points as well, but getting a good broad range of points. So disposals, make sure that we're happy with those. Remember I said that you can have partial, difference goes to reserves, or full, the difference goes to the income statement and you get rid of the subsidiary. Other auditors, make sure you're happy with their competence, you know their findings, you know their strategy. Foreign subsidiaries, income statement, average rates, balance sheet, closing rates, goodwill, retranslated, all foreign balance, all differences go to reserves. Materiality, remember that will go up if you have an acquisition during the year, will go down if there's a disposal during the year. Analytical procedures can come in very handy, particularly if you buy a similar subsidiary, and that might be enough. If it's a small one, that might be all the audit work you need. Goodwill, fair value of consideration. If it's in the future, present value. If it's contingent, fair value. Think of NCI. Have they used the right policy, proportionate or fair value? And then finally, the fair value of net assets. Think about how they've been worked out. Have they collected the contingent liability? Have they collected that intangible that isn't on our accounts but now will be because it has a fair value? Intergroup transactions and balances need cancelling out. Consolidation principles such as get the same year end, accounting policies, add across on an income statement, the holding company and the subsidiary, and on the balance sheet the net assets, that sort of thing. Don't add across an associate. If you buy a subsidiary during the year, then pro rata your income statement, and similarly if you dispose of one during the year. Accounting policies we just mentioned. Additions can be step, which means 20% say to 60%. You revalue the original 20% at the time when you get the extra 60%. Also with additions, obviously you have the further additions as well, from like 60% to 70%, and that is just NCI will go down, you will pay the money, the difference between the two goes to reserves. Make sure you understand the group structure, make sure you understand fully which ones we control. Okay, think of IFRS 10 now, which ones we control, and make sure if we do control them, even though it might not be obvious that we do, that they are consolidated. A timetable to work out how we're going to visit all the subsidiaries, how we're going to get the component auditors working for us, etc. Associates, make sure that they're accounted for under the equity method. So there you go, disposal of magic pasta. It might help in the exam. I hope it does.